So we turned about 7 doors, raised rents, and we went from cash flowing $10,250 to $17,500 a month. That's leaning into the problem. It did cost us money. We did have to come out of pocket and pay for it, but we didn't run from the problem. We leaned into the problem and fixed it, and we have grateful tenants. That's what I'm talking about, leaning into the problem.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 352. As you build your real estate investment portfolio, it's essential to have the right type of attorneys to keep you out of trouble and help ensure success. Today, we're going to talk with a real estate tax attorney who is also a successful real estate investor. Brian Boyd is the author of Replace Your Income, A Lawyer's Guide to Finding, Funding, and Managing Real Estate Investments. And today, he's going to share his best advice on getting into real estate investing and why he believes that now is a great time to be building your portfolio. Brian, welcome to the show.
Thank you for having me, Brian. It's good to be here.
How did you end up getting into real estate investing? Because you have your own portfolio as well.
That's a good story. So in 2015, I was out turkey hunting with a buddy of mine, and we were talking about passive income. It didn't matter where the income came from. We just wanted to make more money without spending more time in the office. So what we did was discuss his business. And his business is wonderful because it allows him to make money while he sleeps. And I don't think people really understand how valuable that truly is. So he had or still does have, in fact, a laundromat business. And so we were talking about it. I was working 6 days a week, kind of miserable in life. And from there, I decided to cash out my retirement and open a laundromat. After a year of having that laundromat, I sold it to somebody who was looking to do the same thing. And I took that money and I bought my first short-term rental. We wanted a place where we could go and enjoy if we wanted to, that wasn't too far away. But at the same time, we wanted it to pay for itself. Well, from that first short-term rental, we then bought 2 single-family homes. A year later, we sold that short-term rental and bought 13 single-family homes with that money. And from that point on, we have just been buying and selling and building our portfolio, raising our ROI, and leaning into the problems that most people tend to run away from. And it's been great. You know, we're cash flowing anywhere from $25,000 to $40,000 a month. So we're really happy with it. I think we're very close to one of us stepping away from our full-time jobs and just running real estate full-time.
You said a couple of things in there I want to dig into. One is you are stepping into problems and challenges that other people tend to run away from. What are some of those challenges?
So we were letting a property manager run our portfolio in Chattanooga, Tennessee. And I got a 1099 and I looked at it and I'm like, these numbers aren't right. So I started doing an audit of the numbers and I was like, this is off by like $40,000. Well, he had sent us a 1099 for $40,000 more than we actually received. So I called him, we discussed it, and he's like, oh, no, that's how we do it. Immediately, I called my accountant, had her do an audit of every single repair that had been done on the property, every single charge we'd been charged and paid for. And then I ran to Chattanooga that Monday morning and knocked on every single door, talked to the tenants, found out some things were not right. They were being charged for things they shouldn't have been charged for. They had paid for things that hadn't been done. So we took over the portfolio and actually found that the houses had been neglected quite a bit. Now, Chattanooga is only 2 hours from me. So this wasn't a far go for me to go. And immediately fired him and then started repairing every single house. We have, like I said, we had 13 and we actually have a duplex down there. So 14 properties. We ended up putting about $400,000 cash into these properties. And in doing so, new roofs, new siding, new doors, new windows, new appliances, taking care of these tenants because these tenants, this is their home. And I don't want tenants to live in a place that I wouldn't be happy to live myself. Now, I'm not saying we put in stainless steel or granite countertops, but we did bring them up to what I thought was a good B-class property. And in doing so, we did have to turn some tenants. So we turned about 7 doors, raised rents, and we went from cash flowing $10,250 to $17,500 a month. That's leaning into the problem. It did cost us money. We did have to come out of pocket and pay for it, but we didn't run from the problem. We leaned into the problem and fixed it, and we have grateful tenants. That's what I'm talking about, leaning into the problem.
That's great. That's also one of the reasons people don't want to get into real estate investing, because they would have to lean into the problem like that. One of the things you said was you started with a laundromat that you sold, then bought a short-term vacation rental, and then sold that, and then laddered up to build your portfolio. Was it all profit as you laddered up, or like how were you financing and being able to acquire to the point where you have how many units right now?
We have 25 properties.
So talk about that process of just laddering up and how you were able to come up with the money to actually acquire these properties.
So initially it started with our own retirement. I'm self-employed, so I had a SEP, a simplified employee pension. I liquidated that and I took the hit on it. I took the 10 and 10 hit, the 10% tax and the 10% penalty on it. Used that money to build the laundromat. The laundromat then, after a year, I sold for a profit, took that money and bought it was a Gatlinburg cabin. And we sold that a year later for $70,000 profit. So we had our equity into that property. And then I like to tell people, aim small, miss small. So we went from a $400,000 property that probably was just breaking even to looking for something a little smaller, like 2-bedroom, 1 baths, 3-bedroom, 1.5 baths, under $80,000. And this was in 2018, 2019. And we went to Chattanooga, where I'm from and my wife is from. And we knew that we could get the rents because when we were looking online and we were using things like realtor.com and Zillow and MLS to just find properties. We cobbled together 13 properties and bought them. So we put 25% down on that portfolio and they were cash flowing immediately. So if we bought a property and on average, each property was $40,000, we were making at least $800 a month on them. So the rents were there. They were paying for themselves. Now, there were a lot of repairs that had to be made. And I just told you about $400,000 we just put into it. But the rents were there. Those properties do exist. My law partner just bought a duplex about an hour from here for $42,000. He's going to rent out each side for $800. That's a home run. So these do exist, and you don't have to put in hundreds of thousands of dollars. You can go find properties for around $50,000 and rent them out for $800 a month. And that's $300 a month, over your 1% rule. So I would say that, it doesn't take an extraordinary amount of money. I encourage people to aim small, miss small. Don't go out and buy the 5-bedroom, 6-bath vacation rental. Don't do that. Go buy the conservative, small house, 2-bedroom, 3-bedroom, 1-bath, 2-bath that you can rent to a family that is going to be their home and they're going to pay rent every month like clockwork. Do that first. And then once you do that, you're going to be surprised how fast you're going to build equity in that property. Because while they're paying you rent, they're driving down your note on that property. And with appreciation, even at 3 to 5% on most years, the COVID years have been unusual, but on most years, 3 to 5%, you're going to see your equity grow exponentially faster than you possibly thought it would. With that equity, you then have created your own little bank. You can go in and borrow that equity, and there's your next down payment. So that's how we have leveraged up into these properties. And it hasn't been, oh, we're going to liquidate my wife's 401k. No, not at all. Don't do that. Buy a small property, get your foot in the water, test the waters. If you like it, keep doing it. It's there to do. You can do this, but don't go out and liquidate your 401k or your IRA. I simply wanted to do this. I have clients that do this. I help clients do this. And I knew this is where I wanted to be. This is my space.
What's the profile of the type of neighborhood and residents that you're renting to?
In Chattanooga, we're in about 4 or 5 different neighborhoods. In Knoxville, we're in just one type of neighborhood, which is mostly college students. In Brownsville, we're in multifamily. And in Chattanooga, and I'll talk about Chattanooga more, we have a duplex that is in the heart of a gentrification zone that is just exploding. When we bought that property, it didn't appraise, but we knew what was going on around it. It would be valuable. So we bought it for, I want to say we bought it for $183,000. It only appraised for $170,000. Now that property is worth $350,000. So we knew what was happening, and that was in December of 2020. So we looked around the area to see what's going on. Some of the other neighborhoods, they're all up and coming. Chattanooga has done a really good job of pouring a lot of resources into formerly neglected neighborhoods to bring them back. And so I think 12 of our 13 single family homes are in an opportunity zone, and they're just doing great. They really are. Good tenants, hardworking people. And now they have new roofs, new siding, new appliances, basically new houses.
So were you aware of those dynamics, the opportunity zone, the gentrification zones, the improving demographics when you bought in those areas, or was it just a process of luck that you happened to buy in the right place?
It's actually a process of luck, because they didn't turn that zone into an opportunity zone until after we had bought. But we knew that area of Chattanooga, and we knew that it could be something better. So in fact, we bought 2 houses on the same street, and our goal was, hey, if we can have the 2 best houses on this street, we can actually elevate the community. And so what we did was, we made sure we have good tenants in those houses. We make sure that the yards are well kept. From the street, they look beautiful. On the interior, they're almost brand new. And we screened our tenants. We made sure we had the right kind of tenants. And what that has done, it has elevated the entire street. So now you see houses across the street being redone, next door being redone. So we kind of pushed the whole neighborhood up. Yes, it costs some money, but it helped everybody as a community. And I tell people this all the time. When you are a real estate investor, unless you are just truly passive, investing in syndications or something like that, you're a part of the community and you have an obligation to the community. You need to take care of your tenants and your properties, just like you would your own house. And so we took that obligation on. We know all of our tenants by name. They know us by name. If they need something, we take care of it. But the silver lining to all this, even though it's cost a lot of money, is that we're getting a lot of money back. So we're really happy with it. And, it's nice to see the neighborhood, turn around, really elevate itself.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is health care for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
I love that aspect of community revitalization, going into a neighborhood, improving it house by house. I think that's a great method. You know, it's interesting. We're talking, and up to this point, if I didn't know, I would not guess that you're an attorney. And I'm trying to figure out why. You haven't really said anything that an attorney would say up to this point, but you are an attorney, and you wrote a book from an attorney's perspective on real estate investing. Tell us about that book and why you wrote it.
This book came after years and years of having the same conversation with client after client, sometimes multiple times a week with different clients. And I've read a lot of real estate investing books, and I think they're really great at doing one thing for you. They're really great at getting you excited about real estate investing. In fact, I'd been telling my wife about the tax benefits of real estate for years, and it wasn't until she read Rich Dad, Poor Dad that a client of mine gave her. And she's like, hey, did you know that you could do this and this? And I'm like, yes, I did. I've been telling you that for years. She's like, yeah, but he wrote a book about it. I'm like, right. Yeah, I just have 2 law degrees. I don't know why you're not believing me, but okay. So this conversation with this book and the multiple conversations I had, I started writing an FAQ with all the questions most people ask me on a regular basis. What kind of entity do I set up? How do I find properties? How do I finance properties? You know, do you have a banker? Do you have a bookkeeper? Do you have an accountant? Obviously I'm a lawyer, but who's your team? How do you find these things? How do you property manage? What software do you use? So that book in turn those FAQs led me to flesh that out. And I'm like, let me just write all this down and put it into a book for people. And so these chapters are in this book are the chapters that have been hours of conversations with people. Sometimes I'm just repeating myself. And quite honestly, nothing I'm telling you in this book or anybody in this book is secret knowledge. It's just people don't know what they don't know. And that's okay. I'm not a doctor. If I break a leg, I'm going to go see a doctor and say, hey, will you fix this? If you're going to invest in real estate, you probably should go talk to a real estate attorney and find out, how do you protect yourself? How do you protect your assets? I like using LLCs. And when I talk about the type of entity in this book, I explain all the types of LLCs. I explain pass-through treatment. I explain what S Corps are. I explain what C Corps are, trust, limited liability partnerships, which ones I prefer to use and which I am using for my clients.
Which ones are you using?
I use a lot of LLCs. I've had a lot of people call me lately about land trusts. And honestly, I eschew land trusts. I prefer LLCs. I like the flexibility of LLCs. I also like the corporate protections. I've heard a lot of people ask me questions lately about, well, what about piercing my corporate veil? And I think there's a little bit of ignorance out in the community at large about what does that mean to pierce the corporate veil? Well, the corporate veil is your legal protections of a corporation. And typically to pierce the corporate veil, they have to have a showing of fraud. So as long as you're not trying to defraud people, you're running your business like a business. Piercing the corporate veil is what we call an extraordinary remedy. And that is so unlikely to happen unless you are just out there scamming people. So I don't think your listeners or my clients or anybody else that is in this real estate investing world is out to scam people. So I want people to be more comfortable with the concept of LLCs and not think, oh my gosh, I have to throw everything into an irrevocable trust. No, you really don't.
If someone is buying a single family house as a rental, should they keep it in their own name and just get really good insurance, or should they put it in an LLC?
I would never advise anybody to keep any investment in real estate in their personal name, ever. It doesn't matter how much insurance you have. You can always be named personally in a lawsuit, and you don't want that. You want the LLC protection. The LLC protection is going to, one, it's going to provide you the corporate formalities that you need and the corporate protections. It's going to make a distinct entity separate from yourself. I never want a client of mine to have their name on a real estate investment, ever. I want to protect their personal assets and everything they've worked so hard for. If that extraordinary remedy is one day achieved and they get through their corporate veil and get to that asset, fine. But they didn't get to your house, and they didn't get to your car, and they didn't get to your savings, and they didn't get to your retirement. I want to protect my clients. And that's what I tell people to do. Never buy it in your name, ever.
When you set up an LLC, are you also doing an operating agreement? And how are you maintaining that LLC and operating agreement over the life of that investment?
So when you create an LLC, it's filing articles of organization with your Secretary of State. Then you create an operating agreement. I create operating agreements for all the LLCs. Then I draft consent actions to open bank accounts, to name the registered agent, to do all the corporate formalities that need to go on in the first few weeks of an LLC's life. That allows the bank account to be opened, it gets the tax ID, and we just move from there. Now, maintaining that over the course of a life of an LLC, it's fairly routine. You need to have an annual meeting, which the Secretary of State will remind you of. I think our annual reports in Tennessee are due on April 15th. So around March, I call my clients, hey, you need to have your annual meeting. I need to see what you've done, and then let's go ahead and file your annual report. In that period of time, I need to know, what have you done over the last year? Have you purchased more properties? Okay, if you purchased more properties, did you draft resolutions to do so? If not, let's go ahead and get those in your minute book, and let's make sure your minute book is up to date. So it's kind of just shepherding clients along the whole process. Because again, clients don't know what they don't know. That's why they're coming to professionals. You know, I don't do my own cost segregation studies. I have an accountant that does that. So, I mean, could I do it? Yeah, I could probably spend time to learn it, but I go to a professional to do it. So that's the whole process of keeping these LLCs up to date. And honestly, if you're doing those things, then you're doing the right corporate formalities that will protect your corporate veil.
What's the number one mistake as an attorney that you see real estate investors making?
Well, you've already touched on buying properties in their own name. I think that's a massive mistake. Another mistake I've seen, and I had a conversation the other day with a physician. I don't know what state she was out of. She wanted to know, well, why would I hire a lawyer to do this if I can just go do it online myself? I'm like, that's perfectly fine. You know, nobody's stopping you. I promise you, you might do it right. You might. But if you don't, you're going to pay a lot more on the back end for an attorney to make it right. And it could be too late. You could have not filed the right tax classification. You may have gotten the wrong type of tax ID number. We call EINs. And that's just a mess to clean up. And lawyers, they're going to charge you for their time. So again, I go back to what I said earlier. If I break a leg, I'm going to a doctor. If I need accounting, I'm going to an accountant. You know, if I need a real estate agent in a certain locale, I'm going to that real estate agent. Build a team. A lot of people want to go it alone. Don't go it alone. This is a team sport. Even though you're the captain of the team, this is a team sport. Trust in your team. And I have a whole chapter about building your team. Go meet with these people. Go learn what they're about. Go learn their backgrounds. Go learn, do they understand your business vision? And, hire your team. Get your team on board. Don't be a penny wise and a pound foolish.
What is your hack or app that you like to use in your business day to day?
We don't like taking rental deposits because we have to keep it in a separate escrow account. We have to account for it if there's interest on it. You have to divvy that up and pay it back depending on the state you're in. So we use a program called Rhino. And Rhino is basically security deposit insurance. So instead of your tenants paying 1, 2, or 3 months of a rental deposit, depending on their credit scores, we just say, hey, sign up for Rhino. It's going to be about $8 a month per 1,000 of rental deposit. So on average, like $16 to $24 a month. They get to save their security deposit, which they're thrilled about because they're not coming out of pocket for security deposit and their first month's rent. They love it. If anything goes wrong, we can make a claim against it and not a big deal. We get paid within 4 days. It's wonderful. If we have to evict a tenant because they haven't paid rent, we just make a claim on security on their Rhino. And it's lovely. I had a client of mine tell me about it and we looked into it and like, this is transformative. This is wonderful. They get to keep money. We feel secure knowing that if anything happens, we have this insurance that we can make a claim on. We love it. I think it's Say Rhino is the website, but that's our hack.
That RHINO?
Yes, sir.
Tell our listeners how they could find out more about you, get a hold of you, and please, one last time, plug your book.
So the name of the book is Replace Your Income, A Lawyer's Guide to Finding, Funding, and Managing Real Estate Investments. If you want to speak to me directly, you can find me at the law firm. It's Boyd & Wills. The website is www.boydwills.com. And we have a contact sheet. Just send that in. I'll be happy to talk to you about your plans, about are you doing things right? I'm happy to talk to anybody, 20, 30 minutes. Let's see what's going on. And if I can help, I'd love to help you. But I may not be the right guy for you. And if I'm not, I will point you in the right direction. But that's how you can get in touch with me. I'm happy to talk to anybody about real estate. And I want to help everybody succeed in this journey in real estate investing.
Brian, thanks so much for coming on the show and sharing kind of your origins, how you started with the laundromat, built out this portfolio that's cranking out $17,000 a month or plus. So that is awesome. And then also just getting your perspective as an attorney on some very crucial things like setting up your entity properly, operating agreements, maintaining that through the life of the investment. Thank you so much for having this conversation with us today.
Absolutely. Thanks for having me, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.